Hello everyone, and welcome to our podcast series in the classical political economy tradition by the Vinson Centre for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. The Vinson Centre runs a series of programs in economics and related fields designed to promote a wider understanding of classical liberal economics and how markets, trade and entrepreneurship promote welfare in a free society. I am Juan Castañeda, Director of the Vinson Centre, and today we'll be hosting Tim Congdon. Professor Tim Congdon is one of the world's leading monetary analysts. He advised the UK's Conservative government on economic policy from 1979 to 1997, serving as a member of the Treasury Panel, the so-called wise men, from 1992 to 1997. He is usually regarded as the UK's leading exponent of the monetarist school of thought and was influential in the late 1970s and early 1980s in the defense of Thatcherite monetarism. After starting his career as a journalist on The Times, he became an economist in the City of London in 1976. He founded the research consultancy Lombard Street Research in 1989, which he left in 2005. He has published extensively in academic journals, in newspapers and magazines, as well as several books and pamphlets, including Money and Asset Prices in Boom and Bust in 2005 and Central Banking in a Free Society in 2009. In 2007, he published a collection of essays on Keynes, the Keynesians, and monetarism, and another collection of essays with the title Money in a Free Society in 2011. He also published the edited volume Money in the Great Recession in 2017. Tim Congdon is affiliated to the Institute of Economic Affairs and is the founder and chair of the Institute of International Monetary Research, affiliated to the University of Buckingham and hosted by the Vinson Centre. Today, we'll discuss monetarism with Professor Tim Congdon. Tim, monetarism comes from a long tradition of scholars. Back from the late scholastics of the School of Salamanca in the 16th and 17th centuries to the present time. Even though it has taken different forms in the past, and indeed we can discuss different types of monetarism later, which are the main principles that define monetarism?
The most important thing, I think, is the connection between the rate of growth of money and the rate of growth of nominal national income. Obviously, for much of the last 500 years, there hasn't been much economic growth in real terms. So it's really a connection between the rate of growth of money and the rate of increase in prices, which then leads to this proposition from Milton Friedman that inflation is always and everywhere a monetary phenomenon, by which he meant it's always caused by the quantity of money rising faster than the quantity of goods and services. I think that should be expanded. It should really be, is inflation and deflation are always monetary phenomena.
And this explanation of changes in prices applies to different types of monetary systems. So let's say the gold standard and the fiat standard, as the one we have now.
Yes, indeed. Let's just be clear that until the 19th century, the quantity of money was dominated by metals, precious metals usually, gold, silver, and that then implied a certain kind of monetary theory because actually there wasn't much banking in the modern sense. Then through the 17th, 18th, 19th centuries, banking became more important. Banks, of course, could issue banknotes, which are paper. So you had a kind of hybrid system, which is a mixture of metal money and paper money. And then in the 20th century, bit by bit, the metallic basis declined. Britain left the gold standard in 1931. The United States broke the link between the dollar and gold in 1971. And since 1971, all money essentially has been paper, or it takes the form of bank deposits, so-called scriptural money, or nowadays, it's just an entry on a computer keyboard, so it's digital money. At any rate, through all of this, there are applicable theories of economics, the quantity theory of money, monetarism.
So in the last few decades, central banks have been given a primary mandate to maintain price stability. If there is solid evidence to support the relation between changes in the amount of money and in prices over the medium to long term, do central banks incorporate this relation in their models?
That's in some large part a rather technical question. There can be simple models, and the quantity of money revolves around a very simple equation, mv equals pt. The quantity of money multiplied by velocity, the number of times it goes around, is equal to prices times transactions. That seems pretty simple. When you get detail, it's not. But you also get, say, a model which says that prices are going to be equal to costs. And costs are going to be labour costs principally, material costs, and we need to allow also for profit margins. It's also a relatively simple model. I think the important question here isn't really, what kind of models does the central banks have, but do they understand the processes driving inflation? I'm afraid one of the features of central bank models in the last 10, 20 years is that they have tended to exclude the quantity of money from the analysis of the economy altogether, not just from the inflation process, but altogether. And we have this idea that inflation depends upon what's happening to wages, which depends on what's happening in the labour market, the rate of growth of demand, and then the rate of growth of output. It depends on the rate of interest, the central bank rate, and the rate of, the degree of overheating or slack in the labour market depends upon how output's growing relative to trend. And in all of this, this is a so-called, I've just simplified the so-called three-equation New Keynesianism, which is supposed to be the sort of workhorse, so-called workhorse of central bank modelling. There's no reference to banking and money. Now, in my view, that's a disaster. And if we want to understand why there's been an outbreak of inflation in the 2020s, it does come back to what central bankers believe, because what they believe then determines what they do. And this very inadequate and just basically it's incomplete model of the economy, this three-equation New Keynesianism, is largely to blame.
So what happened to this tradition of, if you like, this well-established empirical evidence between, the relation between changes in the amount of money and changes in prices? What happened to that? I mean,
Well, I think it's important here to say that economics is not like physics. Economics is one of the humanities. There's a big political element in it. And there are many people, in economics, particularly in universities, who are of the left. They don't really approve of free market capitalism. And it's fair to say that the quantity of money and monetarism are associated with the supporters of free market capitalism. Now, Milton Friedman, who is one of the key monetarists, has denied this. You can't. I'm sorry, Milton. If you were still here, I would quarrel with you about this. It really is the case, and you're a very good. Friedman himself was a very good example of it. That he was a strong believer in free market capitalism, and also supported monetarism, monetary control of inflation. So, what you had really I'm simplifying, but if we go back to the 19th century and the early 20th century, there was no really macroeconomics as such. It was very much a growing area, but there was the theories of the trade cycle. In all of that, money, banking, credit, the quantity of money were important. You then had Keynes and the Keynesian Revolution, which to some extent reversed that through the 1940s, 50s and 60s. We then had the first serious outbreak of inflation in the late 60s and 70s. And along comes the monetarist counter-revolution, which insists that inflation is caused by excessive growth of money. Then in the 1980s, some difficulties applying these ideas in practice. 1990s, a kind of counter-revolution. And then in the 21st century, we've had really this sort of, might call new Keynesian counter-revolution. In my view, the universities are really where these ideas, the new Keynesianism and so on, really got going. And they are, as I've just said, they are to blame really for what's happened to inflation in the 2020s.
Back in 2008...
can I just say on all this that
Sure.
If you look at the evidence, the relationship between money and inflation in the last 30 years is as clear as in the previous 30 years. The idea sometimes made that the relationship is broken down, whatever, is just not true. You just have to, if you're going to approach the data in a way that unsympathetic or even being outright hostile to it, you can always find a data series that disproves the monetarist arguments. I'm sorry. What's happened in the 2020s is an emphatic demonstration of the continuing validity of the quantity theory of money.
I'm going to refer now to the last two crises. In 2008, you successfully predicted that despite the surge in the central bank balance sheets in leading economies during the global financial crisis years, the result wouldn't be inflationary, that's what you said, but rather deflationary.
Yep.
This relates to this comment that I made before about the different types of monetarism we may want to comment on in more detail. Those who believe that it is central bank money what matters versus those like yourself, I believe, who claim that it is the total amount of money broadly defined what matters in the explanation of inflation or deflation. Can you comment on this distinction a little bit more, please?
Okay. I'm going to simplify really to get over key ideas. There are at least three concepts of money. There's the what's called the monetary base, which is essentially the liabilities of the central bank. That consists, for example, of the note issue, that we hold as individuals, the legal tender notes. It also includes banks' cash reserves. The cash reserves are completely convertible into legal tender notes. That's the monetary base. That's the central bank balance sheet money. All right. There's then what's called narrow money, which is the base as held by the public, the note issue, plus in Britain current accounts where you can make payments from those current accounts without any notice being given to the bank. That's available straight away. In America, it's sight deposits. The terms vary all over Europe, of course, and in the rest of the world. And then there's a concept of money which really says that the banking system provides sight deposits and so on, but also there's time deposits may pay a rate of interest, and they can only be accessed with a bit of notice. Now, some people regard these time deposits, these deposit accounts, as not really part of money. In my analyses, they are part of money because the way that people think is it's cash and equivalents. And as far as they're concerned, the money they have in time deposits is really available. It's, the bank will let them use if they really have to. And even include things like in America, money market mutual funds, which are very, very close, very easy to substitute with bank deposits. Now, in all my work, I only use broad money. I haven't really got time this afternoon to explain the detailed argument behind that. But what I would say is that in the last two major episodes of turbulence, my approach has been successful, as you say. In the 2007, 8, 9 great financial crisis, Great Recession period, the central banks hugely increased the size of their balance sheet. At the same time, they forced the banks to shrink their risk assets by tightening up regulations. And that had the effect of causing commercial banks to shrink their risk assets, that side of the balance sheet, causing customers to repay loans. When loans are repaid, that causes deposits to go down. So that the effect of what happened in that period was to cause a rapid growth of the monetary base, while broad money was flat, some years actually going down, only rising by 1 or 2%, and this really carrying on from 2009 through to 2013, 2014 in the USA, the UK, most of the Eurozone, and so on. So I always look at broad money. I said there's going to be a problem, there'll be an entrenched process keeping inflation down after the recession. And in fact, in the case of the Eurozone, there was a second recession, actually. So the looking at broad money gave the right answer then. What happened in 2020 and 2021 with the COVID emergency was that the central banks at this time didn't punish the banks by more regulation. Instead, they eased up on the regulations for a period. And the central banks bought lots of assets. The governments ran budget deficits that were financed from central banks. Broad money grew very rapidly. In fact, there's effectively a kind of a money explosion in the USA, the UK, and the Eurozone, and in places like Canada and Australia in spring, summer of 2020. And I said straight away, with your help, Juan, of course, that this would lead to rapid growth of money and an upturn in inflation, so that as the world economy moved out of the COVID period, there would be an inflationary boom, which turned out to be absolutely correct. Can I just say that this second episode has been a very interesting one, because the line that the two of us took in that period, that the sequel to COVID would be an inflationary boom and highest inflation in 40 years, I think we said that kind of thing, that was completely against the professional consensus. We were right, the profession was wrong.
Yeah, it's extraordinary that using this rationale, this model, this monetarist model, you were able to anticipate a deflationary episode back in 2008 and 9, and also an inflationary episode in the last 3 years.
Yes.
So that's not bad for a theory, is it?
Well, it's not only that. In the 1980s in Britain, we had rapid growth of money from 1985. I said that would lead to a boom and rising inflation. I said it would lead eventually to double-digit inflation. It did. And again, I was out on a limb. The profession, in fact, in 1988 was an extraordinary year because it started off with everybody expecting in Britain a sharp slowdown. In fact, the growth of domestic demand in real terms was about the highest in the whole post-war period. It was an extraordinary boom. My analysis then was that there'd be a big boom. What I say about all this is that I forecast the biggest balance payments deficit, the highest inflation rate, the highest growth rate of output, the highest interest rate at the end of the year. On every single one, I was too low. And I won the forecasting prizes just totally and without any competition. And again, this raises doubts about whether what economists do, whether they really belong to a profession at all.
And yet, Tim, despite all this evidence which you've been mentioning, that applies to the UK and to many other economies, central banks don't really use money, as you said, in order to assess inflation or deflation. One of the, but this is just a guess, really. But one of the reasons why I think they don't is because their models are very much focused on the very short term. So they try to find explanations of inflation.
I think that's a very good point to make.
Yeah.
I mean, essentially what many of these macro forecasts are about is the next year, 18 months, 2 years. In fact, when you get a big shock from a change in the rate of money growth, the adjustment process can be as long as 4 or 5 years. So just illustrate that this is slightly technical, but what the econometric work, the statistical work finds is that the change in velocity is a mean reverting series with the mean value quite low. But if you then look at a series of years, to get that result, you need 4, 5, 6, 7 years of data at least. And so if you get a big shock to the quantity of money, the rate of growth of quantity of money as well, you'll see this. The process of adjustment can take 3, 4, 5 years. And if you're asking for just the next year or two, it's not easy to use money. I don't deny that it's difficult to use money in these short-term time horizons. Some of my big, very successful inflation calls have been looking ahead 2, 3, 4 years, because I know that's how long it takes.
But the problem with the short-term analysis of inflation is that you end up explaining inflation by anything that may be happening.
What they tend to do, again, this is a pattern that the price level can be explained by costs. Obviously in prices there's the labour cost, the raw material cost, the profit margin, and so on. It's affected by energy costs. It's affected by taxes, and so you get this kind of analysis. What I call cost accountancy of inflation.
Pseudo-analysis, I would say.
Well, it's analysis of symptoms, not causes.
That's a good point.
And you see, because what I would say is that, yes, I fully accept that the bulk of the price of an article is the labour costs. But if you're then trying to explain inflation by inflation of price, by inflation of wages, it's trying to explain something by itself. It isn't really a proper causal analysis. I mean, the reason that the monetary analysis is so interesting and it is very definitely a theory, is that the money is created by the banks. It's an entry in bank balance sheets. Why, when you think about it the first time round, why should that have any connection with the overall price level? But in fact, it does have a connection with the overall price level, and the two are held together by a body of economic theory which goes back centuries, and which, despite all the criticisms, still basically works.
Yes, I completely agree, because in the latest, the current inflationary episode we are suffering from at the minute, quite often we hear from policymakers, in particular central banks, that inflation is the result of changes in sectoral prices. Yes. Energy prices.
Yes.
But I'm sorry, that those changes in sectoral prices, they don't explain inflation, the overall change in the price level. That can only change if there is an increase in the amount of money.
Can I also just say on this front that one of the aspects of these inflation episodes in Britain in my lifetime is that you get, upward, sometimes downward, but an upward blip in the quantity of money, the rate of growth of the quantity of money. You then typically see asset prices moving first, and then you see it coming through into the prices of goods and services, prices in the shops, prices on websites, and so on. And you can't explain what's happening to the price of houses, in many cases built decades ago, by cost accountancy, because obviously it was labour costs in the 1930s or the 19th century. So it's crazy but what you see typically in these episodes is that the rate of growth of money changes upwards or downwards. There's then an impact on asset price inflation, sometimes asset price deflation, and then it's subsequently you get the effects on actual the price indices of consumer price indices and the rest of it.
So Tim, let's say that I have the power to appoint you to become the governor of the Bank of England, or to have enough power to make actual changes in policies. How would you translate all these explanations you are giving us today into practical policy decisions in order to maintain price stability over the long term?
Okay, well, the most important thing is to maintain low growth of the quantity of money, low enough to stop prices rising, certainly not rising more than, say, 2% a year, the inflation target, so that if you were to allow, say, 1% a year for the quantity of money to rise faster than the nominal GDP, I'm sorry to be a bit technical, but and you want to have a 2% inflation rate, nothing more, and you've got an economy where trend growth of output's only 1%, the growth of money shouldn't be more than 4% a year. So that's you must be clear that you have a target of that sort, and that you're going to base your decisions on meeting that target. You'll tell the finance minister, Chancellor of the Exchequer in British case, look, I at the Bank of England, I know my job, I know I've got to keep money growth down. If you keep on with a large budget deficit that I've got to finance, possibly from the banks, which is going to cause faster money growth, I can't do this. So, we've got to work together to keep the public finances in good order. That's the first thing that I would do. And certainly, say the first decade after the Bank of England got its operational independence, even the Labour government was pretty good in 1997 to 2007, so it can be done. The other aspect of all this is keeping down to appropriate level the rate of growth of lending to the private sector. And here you've got various instruments. The simplest one is just the rate of interest, which the central bank can control because it's a monopoly supplier of base money. Again, a little bit technical, but we teach all these things, of course, in our MSc at the University of Buckingham. And then in the very extreme cases where you've actually got things going very badly wrong, you've got these operations which are called quantitative tightening, quantitative easing, and these direct operations between the state and the non-bank private sector directly change bank deposits held by the non-bank private sector. So you've got a range of instruments to meet that sort of intermediate target of money growth of around about 4% a year, say. Now, look, I don't want to be too dogmatic about it. Perhaps we should have a range of 2% to 5% because the world's a complicated place. But that's the framework that I would be operating in. And I'd want, one of the worst things, if I woke up in the Bank of England, which I don't expect to happen at all, is that I would be surrounded, at least initially, by colleagues who didn't agree with what I was doing. So one of the most important things would be to try and explain all this to people, the people there and so on, and to some extent, I'm afraid, to try and replace them with people I know who are more on my wavelength. But these things are very difficult. I would just say that at the moment there is, can I use the expression sotto voce? There is it's not too aggressive, and in public there is quite a lot of discussion about the quality of appointments to the Monetary Policy Committee, because the general view they're not of the required quality, quite honestly. And this is partly tied up with the role of the Treasury in all of these appointments.
Well, the inflationary crisis of the last couple of years, I believe it has vindicated monetarism. Now central banks, at least, they are discussing it. They are delivering lectures on it. How do you see the future of monetarism?
I'm very, very pessimistic. The subject is difficult. I may in the last 10, 15 minutes given the impression that the key points are relatively simple, and they are. But there are many disagreements in this subject, and the point of view I express is not a majority view, even though I've been right on many occasions. So I don't expect those monetarists who make a big fuss about the monetary base, for example, they'll carry on doing that. They won't go quiet. They cause as much damage as the non-monetarist New Keynesians in terms of understanding how. So I'm very pessimistic. The other problem is the universities. The central bankers, they're different vintages of central. The people come and go. There's constant revolving doors of appointment syndrome, and the tendency is to appoint the top, meaning the cleverest, the most technically accomplished academic economist. Often those people haven't got a clue, and I really mean it. They should really be appointing people, I mean this, I'm of this sort myself, market commentators, people who are judged by whether they get it right or wrong. It's those kind of people who understand the economy. And so there should be more people like that in the central bank and in central banks of the main countries. I'm afraid what's happening is that the central banks are dominated by academics. They reflecting all of these trends in academic monetary economics. I'm very pessimistic, frankly. I don't expect, although despite monetarism has been successful in this episode, I don't expect it to have any long-run effect on the way central banks operate.
I also think that having a robust monetary history division within the central bank, that will help.
Well, indeed, I think it's exposure to data,
yes,
which I think then persuades many of these skeptics. Absolutely, there's then an awful lot more to say, but at the moment, you still have central bankers saying that we must try and understand the natural rate of interest, and if only we knew what that magic natural rate of interest was, then we could organise the rate of interest and get it absolutely right. Oh no. Let's just be clear, that we've had this dramatic move in government bond yields in the last 18 months or so. Dramatic move upwards. Does that really change the underlying supply side characteristics of the economy? It certainly changes the interest rate that the central banks have set. So this search for a natural, neutral, perfect, immaculate central bank interest rate is a lot of nonsense. And just as a chap at Woodford, Michael Woodford, who's written a book in 2003, Interest and Prices, is supposed to be the Bible of central banking, and that's what he recommends. No, that's not the answer. We want low and stable growth of the quantity of money, broadly defined. That's the answer.
Well, thank you very much, Tim. For anyone interested in monetarism, the relation between money and inflation, you should know that we offer here at the University of Buckingham, with the Institute of International Monetary Research, an excellent master's program in money, banking and central banking, and you are one of their professors teaching in that program. So thank you, Tim, again for joining us today, for your time.
Thank you.
Thank you all very much for listening. This podcast is edited by the Vinson Centre at the University of Buckingham. You can visit our website at vinsoncentre.com to access our podcast series and know more about the programs and events we host, both in Buckingham and in London. Please subscribe to our newsletter if you want to receive timely information on the Vinson Centre's agenda.